Hey, what's up guys? John here. If you're looking to double, triple, or even 10 or 20x your net worth, the opportunity to do that is going to be over the next 24 to 36 months for the smart and savvy investor and entrepreneur that wants to go out there and start to buy real estate or start a business or grow a business and scale a business. The reason for that is because we are in the biggest wealth transfer we've ever seen, and we look at what's happening in the housing market, the real estate market, the mortgage market. It's all very revealing as to what happens next. I've been talking about a big crash coming in real estate, and it looks like it's happening in a very normal way, whereas we start to see slow declines in sales volumes, more inventory, less buyers out there, interest rates rising, and people start to think, you know what, this is just going to normalize, it's going to stay here. But what they don't realize is that we are like a sinking ship. And when this thing goes down, that is when the real value is going to be made. The real money is going to be made. So if you're looking to invest in real estate, give it a little bit more time. Build out a framework and a plan and a strategy. Get your credit in order, get the cash in order, get everything ready, because I think we are going to see that opportunity unfold. Take a look at this. This just came out Business Insider. Also, please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the housing market. The share of listed homes with price cuts has more than tripled since the start of the year. The housing market may finally be at an inflection point. Data from Realtor.com released Thursday showed a steep decline in the median national list price for homes in October, while the share of homes with downward price adjustments has tripled since the start of the year. The median national list price fell to $425,000 last month, down from a peak of $450,000 in June, while the percentage of homes on the market have seen a price surge 20% last month, doubling since October of 2021. Homes are also spending more time in the market. The report added, with the average listing price lingering for 51 days in October, 6 days longer than the year before. The report attributed to the extra time to a slower turnover in inventory. At the same time, the overall inventory of active home sales across the 50 largest metropolitan areas in the U.S. increased 46.4% over the past year through October 1st, right? So we're seeing what's happening in the residential sector, but I've always stood alone on this topic, saying that I believe rents are actually going to plummet, rents are going to fall. There's been so many people that have come out, even with large followings, telling me that I'm so wrong, that I don't understand real estate. And in 2008, rents stayed relatively stable, and it was going to be another basically 2008 again. If the housing market crashes, rents will be fine. But my whole philosophy is that rents, in fact, are not going to do that. Rents are actually going to fall in a very big way, and I think we're going to get back all of the gains that we've given, or that we've received, investors have received over the last 2 years. And I think it's going to happen over the next 1 year or maybe 2 years. And the reason for that is we're seeing a variety of different things happen, one of which is a lot of home sellers miss the housing market. They're going to list their homes for rent because they simply won't have the equity to sell it. We're going to have retirees that don't have the money to make it through the retirement. They're not going to want to sell and take this fiat currency. They're going to want to rent out their property. You have 1.5 million to 1.7 million home builders, or homes that are coming on the market from builders that likely aren't going to have buyers. They're going to likely be on the market for rent. You're going to have all these layoffs. 58% of all employers are scheduling layoffs. You're going to have all these people trying to hold on to their homes, and they're going to only have one option. It's going to be to rent out that property. However, when we start to see all of the influx in demand, all this new inventory that's being built, I think what we're ultimately going to see over the next 24 to 36 months is just more and more inventory, and it's going to be more landlords, more property owners fighting over getting a good tenant, and people are going to be looking for the better tenant. They're not going to be looking for the highest price. They're going to look for the tenant that has money, that can pay 2, 3, 4 months up front, one that has stable income, good credit. That's who they're going to be working for, and they're going to be trying to get. And when we look at the data right here, it suggests that this is just the beginning. So in September 2022, rent dropped 2.5% from the previous month, the largest such drop since September 2020. The two reports came out Thursday showing that rents nationwide declined in September from the prior month, and the data sets from Redfin and Realtor.com found year-over-year rent growth decelerating. So think about it like this. A multifamily real estate investor over the last couple of years is looking at rent growth saying, hey, rents are up 20%. This is a great investment. I can go buy a real estate deal. I can borrow cheap debt at 3%, 4%. I can borrow this money and I can buy, this asset sure, rents are only at 5%, but if rents grew last year at 20%, then maybe they'll grow another 20%, and then I can make all that extra money. This is going to be such a great investment. However, what ultimately happens now is we're seeing rates go from 2.5% to 3% to 6 to 7 to could be 8%. So we're seeing the cost of actually financing that deal skyrocket. We're seeing the rent starting to come down. Insurance costs and property taxes are going up. So what is this going to look like? It's looking like a nightmare scenario for a lot of leveraged landlords. And it's not just, certain markets. A lot of people are going to say, oh, it's not my market, John. It's everywhere. It's nationwide. People just don't realize yet because it's just so fresh. This information is so new. Rents creep down. This is yesterday. Rents creep down across the country. Yesterday, San Francisco rents are falling 6 days ago. Rents are starting to fall across the U.S. last week. Rent prices are finally falling in most major cities. Rents are falling contrary to consumer price index data. So you get the context. This is just over the last week. Residential rents are declining in many real estate markets. How should investors respond? They're not going to have a choice. There's no response. Senior housing trend means, they're not going to have a way to respond. If they bought a deal at a 5% return and just last month, 2.5%, if they were to re-rent the entire building from new, they'd be down 2.5%, so they have a 2.5% buffer. 2.5% buffer on their deal with interest rates skyrocketing, insurance costs and property taxes rising, and the cost of service, manage, and maintain that building is only getting more expensive. You're going to have a situation where these landlords are going to say, you know what? Screw it. Forget it. I'm walking away from the property because it's not. These assets they're financed based on the income of the asset. So they're just simply going to walk away if the building's not making them any money. You look at Wells Fargo, for example. Wells Fargo, it says Wells Fargo mortgage staff braces for layoffs as U.S. loan volumes collapse. Their loan volume is down 90% from a year ago. 90%. Mortgage volumes at Wells Fargo slowed further in recent weeks, leaving some workers idle and sparking concerns. The lender will need to cut more employees as the U.S. housing slump deepens. The bank has about 18,000 loans in its retail origination pipeline in the early weeks of the fourth quarter, according to people familiar with the company's figures. That is down as much as 90% from a year earlier when the pandemic-fueled housing boom was in full swing, said people who declined to be identified speaking about the internal matters. So you have a company like, Wells Fargo, volume down 90%. You look at, for example, this company, Acropolis Mortgage, they're laying off 100. You have Better.com, Bank of America, all these big organizations issuing massive mortgage lenders layoffs. What is this going to look like? It's very simple. It's very obvious. If you have more sellers that are going to be forced to sell their properties due to the changing economy, and their volume is down 90%, it means that there's a hell of a lot less buyers out there ready to go out there and buy. So if you have more sellers than available buyers, prices are going to be coming down and they're going to be fighting to secure the buyer, not the other way around where the buyer's fighting to secure a seller. And so what is that going to mean? It's going to mean big changes coming. Big changes in the real estate. I think it's going to be one of the biggest investing opportunities that we'll ever see in our lifetime over the next couple of years. And I think that smart and savvy entrepreneurs are paying close attention to this because it's interesting watching just how fast this whole thing changed. I'm in Florida, where I am, rents have grown, 30%, 35% over the last 2 years. And so all of this demand, everyone wanted to be a real estate investor. Everyone was trying to buy multifamily real estate. But they were buying these deals where I am, 3%, 4% return. So if they paid all cash for, a $1 million deal, they're making 30, 40 grand a year. 30, 40 grand a year. What does that look like when rents fall 10%? It looks like an absolute disaster for that landlord. It looks like that landlord's going to lose the building. And I think that's what we're going to start to see. It's not just going to be in Florida and South Florida. It's not just going to be in Austin or San Francisco or Philly or Boston. It's not going to be just the hot market. It's going to be a lot of desirable locations that people were moving to, which is 15, 20 of the most popular metropolitan cities. I think are going to fall pretty hard. I think we're going to see some really big changes. I think there's going to be some markets that are going to hold up better than others, mainly because people were buying these deals at a much wider spread, and these properties, they're a bit more affordable. So there might be $1,000, $1,200, $1,500 apartments. That might hold up a little bit better than, say, the $2,500 to $3,000 one bedrooms when we step into this affordability crisis and people start to downsize. But huge changes going to be coming across the entire market regardless, and that fear is going to set in. And like billionaire Carl Icahn famously said, my job is to buy when everyone has to sell and to sell when everyone has to buy. Buying season's coming. Point blank, buying season's coming. The big question I ask myself is, what do I want to achieve over the next 3 years financially? What is my goal? How do I achieve that goal? How much money do I need? What's my strategy? I think that's one of the biggest things that people need to look at right now. Because when I was a real estate agent in 2008, 2009, when the market crashed, and there was one thing in common. Everyone hated real estate in 2008, 9, and 10. And everyone loved it in 2005 and 6. And the reality is that if everyone is saying that real estate is bad, that's probably when you want to go out there and buy. When everyone's saying real estate is the best and you have to buy it, probably maybe you want to pull back a little bit and reassess. I think we're going to be entering a period where a lot of people are just completely turned off by real estate. And that point, you want to have a ton of cash. You want to have a great plan, a great strategy, a great credit score, be able to go out there and pick up deals, invest. If you need help fixing your credit, we would love to help you at CashNow.Video. Call us now at 561-430-5900. If you want to invest in real estate, start your research now. And the reason you want to do it now, even if you don't want to go out there and invest right now, is because you want to start following the trends, watching the inventory, watching price reductions, watching rental rates. Really start to study it, because what's ultimately going to happen is if you do it every day just for 5 minutes or 10 minutes looking into your market, over 90 days, 120 days, you're going to start to realize the big change that's happening, and you'll be able to really spot value a little bit better than if you just wait and then you try to buy then. Just follow the market, follow the trends. The trends are leaning towards a hell of a buyer's market. What do you think about this? Drop your comments below, hit the like button, subscribe here. Subscribe to my second channel. It's a interactive call-in show and a podcast. If you need help fixing your credit though, definitely start the process beforehand. That was one of the things also I saw in 2008, 2009, was a lot of people, they didn't speak to a lender. They didn't really do anything until it was too late. I always think that the time to invest is you want to start the process before you're ready to invest. You want to get everything in line in advance, because when that deal comes up, you're going to know what it looks like. You're going to be able to go out there and pounce on the deal versus seeing that incredible deal and then not having the knowledge, not even knowing it's a great deal, not having the cash, not having the pre-approval letter, not being able to go out there and invest. So get everything in line today so you can invest tomorrow and make an absolute fortune. I'll see you guys in the next video.